Looking at what banks have been doing with their reserves for a long time. There's something called bank-owned life insurance. And so they take their reserves and they put a percentage of those reserves into cash value insurance plans. But these are high cash, low commission types of plans. And they do it with their executives. And that way they're earning interest without paying tax on that. Well, it's inside of that plan. It's higher interest rate than what they're getting in their savings accounts through dividends. And so the concept here is, how can you create a minimum guaranteed interest rate? How can you have access to your money before 59 and a half with zero penalty? As a matter of fact, get access to that money very quickly, right? Yeah. How can you add a multitude of benefits that if you became disabled, the payments would still happen into this cash plan without you making that payment after 6 months? Or if you needed to go to a long-term care facility in your later ages, that you could tap into the death benefit while you're alive, not just after you're dead. And ultimately, the goal for me is, how do we help you build more cash flow and buy your net worth? Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
We're going to talk about the family bank today.
What do you mean by family bank?
And like, legacy.
Like Rockefeller method, like what would the Rockefellers do? Like cash flow banking, like cut out the middleman, earn interest rather than pay interest, my never fail me strategy. Is that what you're talking about there?
All of the above.
Okay.
It's driven by a question from Lee. He read your book, What Would the Rockefellers Do? And he says he loves the concept of a family bank and is curious to know how you go about getting your family on board to start a family bank.
Okay.
So I guess we'll start here. For those who haven't read your book, what is a family bank?
Okay, so what would the Rockefellers do is looking at what banks have been doing with their reserves for a long time. There's something called bank-owned life insurance. And so they take their reserves and they put a percentage of those reserves into cash value insurance plans. But these are high cash, low commission types of plans. And they do it with their executives. And that way they're earning interest without paying tax on that. Well, it's inside of that plan. It's higher interest rate than what they're getting in their savings accounts through dividends. And so the concept here is, how can you create a minimum guaranteed interest rate? How can you have access to your money before 59 and a half with zero penalty? As a matter of fact, get access to that money very quickly, right? Yeah. How can you add a multitude of benefits that if you became disabled, the payments would still happen into this cash plan without you making that payment after 6 months? Or if you needed to go to a long-term care facility in your later ages, that you could tap into the death benefit while you're alive, not just after you're dead. And ultimately, the goal for me is, how do we help you build more cash flow and buy your net worth? That's why I call it cash flow banking, because we're looking at, you could start financing things yourself and paying interest. You could pay for, kids' education instead of going to getting a student loan. You could, finance their mortgage and you get paid the interest rather than a bank. And so it starts to be ways that you can operate and act like a bank, and you're not subject to, oh, well, right now lending is really restrictive because it's a recession, or, having access to your money versus having it all tied up in plans that have a whole bunch of fees and have a ton of, just make it onerous to get access to.
Yeah. So when you say buying your net worth, what do you really mean by that? That seems kind of like a pipe dream.
Well, buying net worth is buying a death benefit, because right then I get that most people are looking at, well, when I die, that money comes in, so I have to die to benefit from it. Well, that doesn't sound very fun, right? But in the Rockefeller method, what we're looking at is, you have an ongoing concern called a family. And if you want to leave money for future generations, I'm not really looking to just leave money for my kids and grandkids and great-grandkids. I'm looking to create opportunity so that when they want access to cash, they're not going through all the private institutions and paying the interest there. They're paying interest into something that will benefit their heirs in the future as well. So by buying that death benefit, I'm locking that into the future of my family. But because it exists, it's going to boost my cash flow 20 to 50%. So there's multiple ways to do that. Number one, when my dad, as a coal miner, retired, he had pensions. And so he can either take the full amount of the pension, and the day he dies, nothing's left over, or he can take partial amounts. 20% less, 30% less, up to 50% less, to say, well, there's a guaranteed amount of time it will come out, or it'll pay, my mom if he died before her. But we already had this death benefit from a cash value policy, so he got to take the full amount. That meant he had a higher cash flow. Or if they decide to pay off their home and then they want to, instead of have no cash flow come from it, they can take a reverse mortgage, and that death benefit could pay the bank back on a lump sum of cash or a monthly amount of cash coming from the bank, which is the reverse of a mortgage, right? But it would be normally attached to the home. It's attached to the death benefit. So what I'm showing people to do is use that death benefit while they're alive as a way to unlock dead assets in a way. And if people go to freewwrd.com, they can actually get a copy of What Would the Rockefellers Do. And there's an entire chapter on this because it's a big concept, and they can go, they can subscribe on the YouTube channel, and we have more videos on it. But it's that the cash value is one thing and the death benefit's another. The cash value is there to help build cash flow, and the death benefits help to enhance cash flow in the future and be the thing that's left behind so that you could spend all your money without disinheriting anyone.
Yeah. So this is the concept of perpetual wealth.
Perpetual wealth for sure. Yep.
Okay. So let's go back to Lee's question about how do you start getting your family on board? So if he wants to take this concept that you just described, how does he begin recruiting family members to be a part of it? So and does he need to?
So this is crazy. 2 days ago, I'm walking the streets of Antigua, Guatemala, and someone I met, I don't know how many years ago, but definitely right when Killing Sacred Cows came out, before he's even published. His name's Pablo, and he's a chef, and he's just driving by on the streets of Antigua. He's like, Garrett, and he tells me that his parents were like, hey, we're reading this amazing book. It's called What Would the Rockefellers Do?
Oh,
and he never, and so obviously something like that, free WWRD, is you can actually have them take a look and take a peek. Sometimes I find with family, it's best for them to hear outside of the family that it's a good idea than inside of the family.
Yeah.
So that's super helpful, but it really starts with the individual. So you'd start, like I would start with me. I was 19 years old or 18 years old, and I just started putting away $50 a month. And I started paying $262 per month away, right? And then I just kept doing more and more as I increased my income. So it began with me. Then when I got married, we got, policy on Carrie, my wife, and then now we have policies on the kids. And I sat down with my parents. It took me a long time to convince my mom on the whole concept of what we're doing, but now she's bought into it. So a lot of it has to do with education and conversation, but leading by example is by far the biggest way, and progress over perfection. It doesn't matter how much you put away, it just matters that you're doing something.
Yeah. Yeah. And we know, and we hear about this a lot of times in our workshop too, how money personalities vary and money can create tension within families. Are there any contracts that you put in place to lay out so everybody's on the same page and to guarantee that everything will work? Or is this just like word of mouth and trusting one another?
Well, there's really 3 key components that I work with, which are the family legacy rings. Okay. So the first family piece is the family office. This is a big part of the Rockefeller method because the Rockefeller family had so much wealth that they hired their own financial team that only worked for that family. That's where the name family office came from, right? So they had attorneys and accountants and fiduciaries and investment advisors.
One cohesive team working.
Cohesive team working on their behalf. So I like the thought of, okay, my heirs could have access to this financial team that I created, because at Wealth Factory, we built a virtual family office. We weren't just looking to work with one family. We wanted to take the same concept and work with a lot of people that normally wouldn't have access to it. So a family office is critical because I've already got my kids, where they're learning about it, and they're going to be coming to some of those meetings, and even though they're 12 and 14. The second piece is the family constitution. So family constitution is, for my wife and I, a 38-page document that we wrote that said, what are the most important lessons, philosophies, values, principles that we want to share so they could be signposts for the future generations to understand who we are and what we stood for, and that we're talking about how we can preserve, protect, and perpetuate wealth, because it's a dynamic way to have it in our language before the trust kicks in. So it's part of the estate plan. But then we've chosen 5 people that we say, if I'm not around, these are the 5 people that can influence our kids and that have some characteristic that I have, that if I'm around, I'll plan on doing it. If I'm not, they can kind of assist, that helps that they're prepared and that they know what to do moving forward, right? Then the third piece is the family retreat. So the family retreat is, when we were in Guatemala, we sat down and we're having a meeting over breakfast, and we're going through our family mission statement. And we signed up for a family 5K. So just thought you might want to know that. February 1st, we're in a family 5K. Yep. So the 4 of us, and because we're saying what's something we could do together, right? So we're investing in our heirs through experience right now. And we have policies on the kids.
Yeah.
owned by the trust that has the family constitution inside of it. And then we have a family office that's overseeing how all of this gets integrated and implemented.
Yeah.
So that's part of it, but it's simple just to start with. Get a overfunded cash value plan, and you can have the owner be whoever you want. It could be me or it could be my trust, right?
Yeah.
The beneficiary could be my trust and everything that we want to do there, so that there's benefit to the kids, and began with insuring myself. So then you can expand that. And so we've got people that have bought policies on their parents, and that's kind of like one way to do it, but not the only way to do it. And if you never did that, you could still just get it on yourself. If you don't have the health, you could get it on a spouse or on kids, right? So there's a lot of ways to implement this.
Yeah. And it sounds like the family bank concept is just one portion of what you've designed to perpetuate and protect wealth, and
I just want
the concept of legacy, right? Because you're talking about passing on more than money.
Yeah, I don't want. Yeah, we're banking values, but I also don't want my family to go and say, "All right, I want to get a loan," and then they've got to put 20% down, or else there's private mortgage insurance, and they've got to, they might do what my wife and I did when we were trying to buy a home. We were negotiating heavily and getting it priced down, and then someone came in with cash. Well, imagine if it's our family trust that's financing it.
Yeah.
It's the trust that's getting paid the interest rather than a bank. That money can come very quickly. We already know the heirs. They already know the board. So it's something that they could have been being prepared for along the way, not just right when it was time to think, oh, I want this, and starting from scratch. So can kind of teach them responsibility. And I'd rather our family make the money than banks.
You touched on it a little bit earlier, but when is a person or a family unit ready to initiate a family bank? You said just when you were a single.
Yeah, because they just start. I was single. When you put away some cash, you just start. You just get that overfunded policy so that you're getting in the habit. So you're building up some savings and liquidity. You have access to that cash when it's time, and then that can expand and grow just like it did for me 20 years ago.
Yeah. That's great. So another piece of Lee's question was in regards to addressing corporate-owned life insurance policies. Do we want to touch on that?
Yeah, I mean, corporate-owned life insurance policies make sense once you've maximized your personal insurance. So there's only a certain amount of insurance a company is going to give you. It's just like if I buy a car, they're not going to over-insure that car. I can't really go buy like a Honda Accord, insure it like a Bentley, then go crash that and be like, oh, I'll take my new Bentley, right? That's over-insured. There's an incentive for that. So when I'm getting life insurance, they're not going to over-insure me, so to speak. They're not giving me an amount that I want to go fake my death. You'll hear people say, I'm worth more dead than alive, right? That's kind of a concept. So that's erroneous. They're not really going to do that because they have parameters. So I always like to know, what will an insurance company issue me? How much? And is some of that going to be term? Is some of that going to be the overfunded cash value? And, just kind of, once I've maximized the personal side, then I didn't get my first corporate policy till just a couple years ago because I want to maximize all my personal stuff first.
Yeah.
So especially if you're not a business owner, and in the corporate side, I did something called premium finance, where the bank actually financed the policy owned by my corporation. Okay. So, that's great, but I'd already done everything I could personally to the point where I couldn't get any more.
So maybe before diving into getting the life insurance policy, focus on your personal side and you're establishing your family bank first.
Yeah, find companies that are over 100 years old. I prefer mutual companies, meaning they're not traded on the public stock exchange, so they're not spreading dividends amongst policyholders and stockholders and not having to make really short-term decisions. I want to see a minimum guaranteed interest rate of somewhere around 4%. I want to see multi-billion dollar companies. I want to see all A ratings. I want to see where I can put flexible amounts of money above the minimum. That's the overfunding that can help fuel the cash to be, it doesn't pay as much commission, so it might not be as enticing to some of the agents that are selling it, but it's going to be a great situation for the individual, because what we're trying to do is mimic how does bank-owned life insurance work? How would the Rockefellers have designed it? They didn't have to go and pay commission. They just get privately built. There's another thing called private placement life insurance, but usually you got to have $1 million a year that you're putting in for private placement.
Yeah, that's a lot of cash.
That means not a lot of people,
right?
are going to be able to do that. So we're trying to mimic what's the closest thing we can do with something that's available to pretty much everybody, and it's just in the design. So I've given a little bit of the criteria. The overfunding is what's called PUA, paid up additions, that you're putting more cash in. It's available as soon as it's in there. You can borrow it, which means that they use your money as collateral and give you their money. And then you still earn interest, right? But you have to pay interest to get access to that cash. Or you could take a withdrawal. I usually borrow because I want to pay it back.
Yeah.
And if I don't pay that loan back, it just gets subtracted from the death benefit, and the rest comes back into the family bank, into the family estate plan. So have the family office. I look to be really efficient. Instead of overpaying tax, I'm putting money in my cash value. Instead of speculating in the market, I'm putting money into cash value. When there's, distress or opportunity, I can pull the money out of the cash and invest and then put it back in. I can finance things, if I just take a withdrawal, or I could borrow and I'm still earning versus what I'm paying. And I just, have a lot of options that way. And nobody's going to deny me the loan because it's my money that's set up as collateral.
Yeah. Yeah. Just kind of looping back to something that you said earlier around like getting your family on board, and it started with you and then your wife and your kids and then eventually your parents. Have you ever worked with people who have tried to incorporate siblings, like having a brother and a sister be a part of the family bank concept? Or do you normally keep it as your core family?
Yeah. So far, I would say the majority of people, it's more on the core family side of things, but when you look at the Rockefeller family, there's over 150 people, I think it's maybe 200, that are benefiting from that trust.
Yeah.
So everybody getting insurance to replenish that trust. Like for me moving forward, I bought the policies on my kids. I'll buy policies on their grandkids. The trust will continue to do that moving forward, but I don't have my sisters included in this plan. It's a little bit complicated on that side. It's a little bit easier. And I'm not saying it can't be done. It's just they've done it for themselves. So they've gone out there and implemented with the same people I went to and implemented this in their own life. My mom and dad have as well, but it's all kind of individualized where moving forward, my kids and their kids, they'll all have this overriding trust. They can go build stuff on the side and on their own. It doesn't all have to come back here, but I'll have the overall structure for them where they won't need to go to the banking system.
Okay.
I've seen 90+% of life insurance policies are just not designed properly. They underperform and they end up costing you years of precious time and way too much commission rather than your own cash. Today is about how you design a policy to your advantage.
This is
what up?
Hey.
Just like, what up? Stop.
What are you gonna say? What joke?
What up,
what joke do you have?
I don't know. I just said, that's what came to my head is to say what up.
We're very formal around here, as people can tell.
Yep.
Okay, Todd wrote in today, and his question, like you said in your intro, is actually a really fantastic question. I think a lot of people will be able to relate to who are in his similar situation. But before we dive into that, the financial word of the day today is fiduciary.
Oh,
Say
nice.
that 5 times fast.
Yeah, fiduciary, 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 fiduciary. There you go.
You did much better than I thought. Much better than I would if I did that. So a fiduciary, and I want you to add to this because you have a lot of thoughts on this, but essentially a fiduciary is a person or an organization that acts in the best interest of another party.
Right.
Okay. So how does that apply to the
fiduciary responsibility, right?
Yes. So
what if the best thing for you didn't have to do with getting them commission? They should be acting as a fiduciary in your best interest. I saw this for the first time when I was 22 years old and I saw a family office, which showed like this comprehensive financial team working on the behalf of a client, doing real due diligence and analyzing everything. And they were just paid to be part of that, not paid for the transactions, but they also were looking to advance that client's interest. So there have been new rules that have come out with fiduciary responsibility for financial advisors. And I think that there's a lot of progress in that, but there's still some problems in that.
Some work to be done.
Yeah, there's work to be done because how do you determine what's the fiduciary responsibility and how much did Wall Street and the institutions determine what that is versus like what was really right for the client? Because I'm still seeing far too many clients without enough cash on hand, without enough liquidity, still using the only primary investment vehicle as the stock market, even though they're business owners. So it's progress, not perfection,
So does every financial advisor have a fiduciary responsibility?
It depends on what they mean by financial advisor. You definitely, when you have certain licenses, like a Series 65, have a fiduciary responsibility, but there's still interpretation of what if you're just a life insurance salesman. So yes, there are now fiduciary things that are spilling over there, which is great. But, it's still relatively new that they've upped the game here. And so I think it's yet to be determined of how much more needs to be done versus doesn't. The only issue I have with the way that it goes is like sometimes people rely so much on advisors, and the more that they feel like they have a fiduciary responsibility, the more they think they don't have to think as a customer. But I feel like to delegate your finances completely is reckless, just like you can't delegate your health completely.
Yeah, I know.
People can't work out for you, right? People can't eat right for you. Now, you can hire someone for your food. You can hire trainers. You can do it more efficiently. But it should be looked at as a partnership, not as just tell me what to do.
Right.
Because, that's where I think far too many people got into trouble.
They put too much trust in another person. Yeah. Well, not too much trust, but they've just negated their own responsibility.
Like to me,
influence.
I think retirement plans are relatively reckless for people that have loans that need to be paid off first, that don't have enough liquidity, that have undercapitalized their business and have been living a very chintzy, miserly life. Yet they're not going to have a problem. The fiduciary thing is like, well, it was a low cost 401k versus a high cost 401k, you know?
Yeah, so the person that you have in your life that's
so it doesn't mean they're good
you,
strategists.
Right. I was going to say, if they're not looking at your personal situation and the whole picture of your life,
Yeah, it's a step in the right direction, but it's still limited within its scope. Like it's not what you see with the family office. I'll tell you that much.
Yeah, very different from, I mean, I've never experienced a family office, but just from your stories, it sounds very different. Okay, so Todd's question. He said, I read your book, What Would Billionaires Do? And I loved it. I have begun putting pieces into place, beginning with whole life insurance. My dad was a State Farm insurance agent for about 19 years, and I have 8 policies, one of which is a UL, a universal life, which I plan to convert to whole life. During all this corona craziness, I have cashed out my IRA and plan on doing so with my Roth and my wife's Roth as well. I went to deposit those funds into my whole life policies for cash value, which they then said the only way we could do so is if we pay forward the premium, which is not what they said previously, which would only add some to the cash value. However, I can add all of the funds to my universal life policy. So here's my question. Should I add the proceeds from my IRA and Roth to my universal life policy cash value and then convert it to whole life?
I think that right now it sounds like a lot of limitations based upon the company, not based upon the product, if that makes sense.
Okay.
Like, because normally what you want to look at is a PUA, right, or paid up additions, which allows you to overfund, allows you to add more cash. But some, maybe because you didn't have it when you first got the policy, maybe their policy is they don't let you add it later. Other companies, you just have to maybe get a normal test that you'd get with blood and urine. If you're starting a policy, some let you have a lot of flexibility. You pay a minimum of $100 a year, but you could always add more. So I would really look for a company where you have flexibility with the paid up additions and that you could actually do something called a 1035. A 1035 allows you to roll your existing policy over if there's gains. So if you've got more gain than what you put in, if you cash it out, it would be taxable. But a 1035 allows you to roll that to another policy, whether that's a whole life. It doesn't matter if it was a universal life first or variable universal life or anything that had cash value. You can roll it to a whole life that could be overfunded.
Yeah.
And that would prevent any tax on that rollover. So 1035 would be one thing to consider. The other thing that you are going to have limitations on is known as the MEC limits, MEC, Modified Endowment Contract. Basically, when the universal life policies got created in the late 70s, early 80s, it was kind of like this place where people could just dump tons of cash in and not have to pay tax when there's really high interest rates. And so the government came in and said, hey, we've got to create some corridor here or some limits that you can't just put everything in there without tax consequence. It really needs to have a benefit that when you die, you're not a burden onto the government or something, right? Whatever they justify to give that death benefit. Well, so you have modified endowment contract limits that you want to only go up to those, not above, because then you can make it more of a tax deferred vehicle and minimize some of your tax advantages. So there's that factor. So 1035, paid up additions, the MEC limit, and then maybe you just have to move it over time, because I think it's important to have at least 3 months of your 6 months liquidity that I recommend inside of, cash in a safe, cash in a bank, and not all in your cash value. Because cash value has provisions that, one, if you need the money tomorrow, you're not going to get the money tomorrow from your cash value. I think the fastest you're likely to get it would be 72 hours. And if you're not wiring back to the place where you're paying premiums or you're having them overnight checks, there's processing time.
Right.
And there's paperwork involved. Sometimes if it's under like a certain amount of money, it's just a phone call and verification. When it's over that, it's a little bit of paperwork, and it just could take some time to go back and forth. When I was buying this very place that we're sitting in right now, I was going to I was going basically to Burning Man, and on the way there, I'm closing on this property, and I have 9 days, and then that Monday's Labor Day, and then we had an issue with UPS. There was a storm on the East Coast, so it didn't come, and then when it did get here, there was a mechanical issue. They didn't move things off the plane, so it took me like 9 days to get my money because of holidays and because of issues in that.
Unpredictable
Less issues when it's just from a bank, but there's a provision inside of insurance policies that says they can take up to 6 months to give you your cash.
6 months.
Yeah. Now every company I have a policy with, AUL, Mass Mutual, Guardian, Penn Mutual, like none of them have ever had that triggered. But the fact that it's in a contract, I think we need to prepare for it, because if there's some crazy chaos going on in the economy or whatever it is. So that's why I like to have a little bit of cash kind of somewhere else. And then you could always filter that cash into the cash value from year to year. And if you pay annual, it's a little bit cheaper than by paying monthly. So that's one consideration. And then you wait till that next year and you've got 1035 provisions. But I'm not a huge fan of UL. I interviewed Todd Langford that wrote Truth Concepts Software on the 10 major issues with UL that most people aren't aware of. It's built on a term chassis. It's about 20% more expensive than term insurance. The cost of insurance can go up over time. There's a lot of factors in that. So I do have one universal life policy, but I'm using it specifically as a death benefit, not as cash value and death benefit, because they can change the cost of insurance over time.
Yeah.
Because I can lose certain guarantees if I didn't make one single payment. Like that's like the seductive, it's the stripper of insurance.
Oh no, where are you going with this?
You're not finding a long-term partner there. You know what I'm saying? I just want the plain, boring, I know it's going to work, a policy here. So I just wanted to see if I could make you laugh with that. And I definitely did. Yeah. So anyway, I would be really careful with using that and then converting it over. I would just like to set it up right from the beginning, look at a 1035. It depends. There are some really good cash value universal life policies that serve their purpose, but some have surrender charges. So it limits how long you have to, it limits how quickly you can move it, and you have to stay in it longer. So that's one of my major issues with that. And I just think it's the company. So I think there's quite a bit we've said here. And Billionaire's Method is, you really mentioned the book, What Would Billionaires Do? And really enjoyed it. It's got some great resources, but if you also go to cashflowbanking.com, they can analyze, they can look, they're not like beholden to one company. There's maybe 24 companies that I would feel comfortable having a policy with. And so they can represent those companies. They can look at what's best for your situation. Yeah. And, in this PUA overfunding type of situation. So that's who I use. I don't own the company. In disclosure, I create content for them all the time, and they're one of the licensees with my intellectual property. So there's definitely a relationship there, and I have influence over certification of the people. So but it's not like it's something I'm dealing with every day or every week for that matter, right?
It's a pretty straightforward and short question today, but it comes in from Chris, and he says, in regards to the cash flow banking, can a policy be jump started at the beginning with a lump sum and then monthly premiums thereafter?
Yeah, there's something called single premium life insurance. The problem is single premium immediately does something called MECing, MEC, modified endowment contract. Have you heard me talk about this before?
I haven't heard you talk about
MECing.
This.
We're just going to teach Stolba.
I'm learning right along with everyone. Here we go.
So MEC means that it's going to be treated more like an annuity almost. Like you put so much money in it that corridor between your cash value and your death benefit has been crossed. See, in the late 70s, E.F. Hutton kind of really created universal life. And it was a way to take advantage of really high interest rates at the time. And they wanted to put it in insurance where there was this kind of tax benefit. Well, they would stuff so much cash in there, the government was kind of like, well, we need to put some type of limit on that. And that's the modified endowment contract. So if you do a one-time premium, it's probably going to be a modified endowment contract. But you can do a lump sum up to that level. Okay. And then there's something called PUA or paid up additions. Paid up additions. Yep. You can put extra cash above and beyond the base, the base policy. And that goes up to that modified endowment contract. But typically, if you max that out from day one, you're kind of paid up after 7 years. It's called a 7-pay test.
Okay.
Okay. So So yeah, modified endowment contract. I once did this with one of my policies by putting in too much money. I hurried and took that money back out before it became official. And there's software that kind of looks after that. But the difference is when you put money into a cash value insurance policy, it's treated FIFO. You've
first in, first out.
Look at this. FIFO, first in, first out. The first dollars you put in premium are the first dollars you take out, which means there's no tax on them, right? Most things like an annuity are LIFO, last in, first out. The last dollars in are the first dollars out, and the last dollars in were the interest. So you have to pay tax by pulling that out. So FIFO is a good treatment. Modified endowment contract would now make it LIFO instead of FIFO. So you lose that advantage, right? Okay. So you want to fund it only up to that limit. When you borrow from your cash value, there's no tax on that, right? Because it's a loan from the insurance company. They let your money act as collateral. You still earn interest on that. Now, there's direct recognition or non-direct recognition. So we're getting in the weeds here for just a minute. Direct recognition is like, okay, we know that you have this loan out there, so we might change the interest rate that we pay you. So that could actually impact you and maybe even create a spread, right? Where you're paying a little bit more than you're earning. Or non-direct recognition is, oh, cool. We're going to act like nothing's going on and just keep it going the same.
Yeah.
I don't get too caught up on those details, but it's just important as we're looking at modified endowment contracts, we're looking at tax treatment like FIFO or LIFO, that when you're borrowing, it's against the cash value. So they're not paying taxes on that. If you don't pay it back, it's subtracted from the death benefit, which is income tax free. So these are all just the basics of how a life insurance policy works.
Yeah.
I personally like to overfund them. I like to set up PUA and put more that goes towards that cash value that can push the death benefit up faster in the future, and it can allow me to access cash faster with less commission. So all of a sudden I get to the break-even point a lot sooner. I was talking to Justin, who's a Wealth Factory member yesterday, and I was doing a podcast with him. He's like read everything that I put out there, and he's loving everything. But, he was saying that his brother, who's an attorney, was like, I don't like whole life. And it like shocked him because he just did. He goes, why wouldn't he like it? I'm like, well, I first learned that whole life was a hole that you throw your money into. Doesn't sound like something to like, is it?
Absolutely not. Not referred to that way.
So I was like, but then I started looking how most of the policies are designed and the companies that design them. Most of them take so long, 10 years. Some are as bad as 20 years to break even. Can you imagine? Like you're going to do better in a savings account for crying out loud. So we have to find the right types of companies, which I prefer mutual companies that are owned by the policyholders versus stock companies, which are owned by the stockholders. So when there's a distribution, it just goes to the policyholders, not to the stockholders and the policyholders. That's one thing I look for. That's a really
good thing to know.
Right. The next thing I'm looking for is what are their PUA provisions? Can I put a little bit in and put more in later, or is it fixed from the time that I start? That's another thing I'm going to consider. I'm looking at, multi-billion dollar companies or $1 trillion company like Mass Mutual that I have a policy with. So I'm looking at those factors. So I want to see really early cash value, but I want to see long-term healthy performance. And I'm looking at kind of the mix between that. So I've got policies with Mass Mutual, with Guardian, with One America, also known as AUL, Emeritus, which I don't love them, but I have policies with them and they're old, so I just keep them. So I've got various policies, and Penn Mutual is the last company. So there's a couple dozen companies that you could do this right, but a lot of people haven't done it right. They're looking at policies from the 1950s that the death benefit didn't go up over time. So I think it's important to realize that whole life has a guaranteed premium that they can never ask for more, a guaranteed cash value that once it's there, it's yours, a guaranteed minimum interest rate that you're earning, right, and a guaranteed death benefit. There's people that have gravitated towards other policies like universal life policies or, other hybrid policies like indexed universal life being probably the most popular today, that they can change the cost of insurance. And that cost of insurance can start eating away at your cash value, or not a non-payment can negate your guarantees. So it's important to kind of see what you really have. A lot of them work the same way as far as the loan provisions, and a lot of them work the same way as far as modified endowment contracts or lump sums that you could put up front to accelerate what's going on. But hopefully this gives people a little bit bigger idea of what's happening here without confusing them. Did it all make sense to you is the question, Stolba?
Well, I'm going to have to rewatch this video myself. I feel like that if someone's just starting out, I think there's a lot of terminology that you brought to the table that just even having an awareness about, they'll be able to go investigate more deeply before they have the conversations, be able to look at the contract with a little more insight and know that they're getting into, something that is a good fit for them. But it's just, don't be discouraged if this feels new and feels overwhelming. Like, rewatch the videos, listen to it multiple times. But just, I think people building up the vocabulary around financial literacy is really important, so they know what kinds of questions that they can ask when they go and they're researching these policies or trying to find the companies that they want to work with. As you were talking, one question that came to mind was when someone's looking for a company, you have A-rated companies and B-rated companies. What's really the difference in the nuance between an A rating and a B rating?
Look, I'd be heavily concerned with B ratings. It's usually the kind of companies I see there are more like term shops. They're really just trying to sell the cheapest policies possible. And you look at their finances, like anything less than the A ratings, which there's multiple A ratings. You got AM Best, Standard & Poor's, Moody's, right? You've got like 4 main rating companies when it's in the insurance industry, and you might have A++ or A-, or, there's different ratings for each one. And I think when you're in the B's, it's a little bit more concerning, especially if it's cash that you're storing there as well as the death benefit.
Yeah. So is any A rating considered a good move, or is there one that's better than the other?
I mean, obviously, if you got like the perfect ratings, but some of these companies get marks because they sell disability insurance and they might be facing more risk of claim on that, or maybe how they manage their portfolio. Maybe they have a little bit more in the stock market, which most of these general accounts don't have that much. So there's a lot of factors that go into it.
Yeah.
I used to understand it a lot deeper and more when I was in my 20s, and I researched this inside and out. And what I realized, especially after watching Big Short, is there's a lot of pressures on these rating agencies to give certain ratings. Otherwise they take there's this underlying kind of competition there that might not give us the accuracy that we're looking for. So you can only rely on those to a certain degree. But I'm saying if we're in, I don't care if it's B+, I want only A ratings across the board, even if it's A- here or there. I want to know maybe why that's happening. And I want to warn people against only looking at how illustrations perform, because I just see, policies that they show an interest rate that's fairly high as if it's going to be that every single year, and it's not. So they go, oh, I could have millions of dollars in this. That's what I was shown when I was 18 with the VUL. It's a variable universal life that's got separate accounts that are like mutual funds. And they showed me 18%, which is totally illegal, but the 90s was awesome. So there's like, oh, this could keep going forever. Then 12% is the top that they can show you, which is still a pipe dream because it's not the 90s anymore. And we haven't seen those kind of returns in the market. And what they should have showed me was 6 to 8%, which totally fundamentally changed because the insurance costs eat up a lot of that, and it doesn't do nearly what it was supposed to do. So from going from being a multimillionaire to having something completely fail because it was all with baseline commission, which was all commission premium versus overfunding. And I know that, some of these insurance agents don't want to overfund because they just want to get paid as much as they can. But I'd rather see them do what's right and get paid a little bit less and just help more people.
Right.
Right.
I'm right there with you.
You want to know the best companies to choose to set up something called cash flow banking, then pay close attention. First, when you put your money in that bank, they take a portion of that money and they put it in a reserve account. Part of the reserve account can be put in an insurance contract. This insurance contract is nothing like most life insurance policies. Has to be set up properly for you to minimize the costs, right? Have to lower the commissions and mimic, in your situation, what the banks are doing. Unfortunately, way too many of these policies are just really high commission and really low cash. It has to be the type of company that performs properly. There has to be very high early cash value, great dividends, a good guaranteed interest rate, and plenty of flexibility. These factors narrow down from thousands and thousands of companies to maybe a couple dozen. I'll unveil which companies to choose, which ones I certify and personally create content for. All right. I'm going to let you ask the question, Chief of Staff Stola.
Okay, let's dive in. It comes in from Justin today. And he says, I'm wondering what insurance company that you recommend going through for whole term policies and what your relationship to Garda Insurance is. I've heard you say that there are a lot of insurance companies out there that offer security through a long history, maybe over 100 years. So what is there to worry about with younger companies? And are their planned death benefits still guaranteed if they go out of business?
Younger companies are like really young kids. Like I took my 15-year-old to start working with him on driving. And I mean, when you just put someone behind a wheel for the first time, it's a scary thing. So that's one thing about the younger companies. There's a lot more to it. But let me address this really directly. First, there's a lot of criteria on choosing great companies. That first one is that they're at least 100 years old. I'd like to see that because I want to see what happens during good times and bad times, recessions and depressions. And, we've seen world wars during that time. So I think that's really important to see when interest rates are high, low, the market's up or down. How do they handle that? The minimum guaranteed interest rate I look for is 4%, because, I want to make sure that if things don't go according to plan, which a lot of times they don't, there's something you can count on. But I also want companies that always have paid a dividend throughout their entire existence, because that means that they were able to pay even when everything else wasn't working out. And there's something in these types of policies called paid up additions, PUA. Paid up additions are where you're putting in extra cash above the base of the policy, and it fuels more cash value and can even increase your death benefit. I want it to be flexible where you could put some money in and then another month maybe put more money in, or another month put nothing in, because I know that cash flow isn't always predictable. And we've seen, especially during recessions of 2000 to 2002, 2008 to 2010, and even what we're facing right now in 2020, that flexibility can be instrumental to make it to the other side. So I also prefer mutual companies over stock companies. And a mutual company is owned by the policyholders, where a stock company is just like it sounds. It's on the stock market. So if they have earnings or they have dividends, they're going to give the policyholders some of that, but they're also going to give stockholders some of that. And if you've watched any of my other videos, I'm not really big on stock market companies, because there's something called shareholder value. And I feel like a lot of times shareholder value takes such a huge priority because it's a fiduciary responsibility, meaning that's what they have to look out for, that many times they're not thinking about employees or customers. And, we've seen a lot of just terrible things happen in the public market. So I prefer a mutual company as well. So hopefully you get enhanced or better dividends. So that's the very first part on like choosing a company as far as criteria. Yes. Now I could even list some of the companies.
Mm-hmm. So one of the points that you said was a minimum guarantee of 4%. How does one determine that that's
contractual? Okay. It's in the contract.
Okay. But are there fees that they need to look for in those plans, just like they do 401ks? And how do they determine in the end they're actually going to get the 4%?
That's a really good question that unfortunately the insurance companies don't do a good job at answering. Mm-hmm. These policies are not unbundled. So it's hard to know exactly what the costs are. You just have to look at what the net return is when you look at the cash value. So you compare multiple companies and illustrations to kind of analyze that. Mm-hmm. And that's why it's important to have a certified cash flow banking specialist. So Guard is a company that is mentioned in this question. So two gentlemen, Ryan O'Shea and Del Clark. Del Clark became a client of mine in 2005. Ryan and O'Shea and I went to high school together, and he eventually became a registered investment advisor. And my firm Wealth Factory, we had Del as one of our financial architects for a number of years, and Ryan O'Shea as an accredited network member, registered investment advisor, to help our clients analyze their investments. Well, they came together and said, what if we created an insurance company and got certified so that we could be an approved vendor, like an accredited network member? And so they built that over years. And so I create content for them and license content to them. So I actually have a profitable relationship there, even though I don't have any ownership in the company and don't tell them what to do. But at the same time, for them to get those referrals and for those, for me to create content for them has to meet the criteria of how the policy design is. And so it's been a great relationship that way. And so Garda can write with multiple companies. They're not beholden to one. Like I know some people that are with good companies like Northwestern Mutual, but a lot of times Northwestern Mutual doesn't like them writing business outside of that. Mm-hmm. And so they're putting too many people in just one type of policy. And Northwestern Mutual also doesn't like for people to borrow from their policies. They tend to have a little bit of penalty on the commissions for the agents. So even though I would love to see that policy, I think it's a good policy for people, I don't run into it quite as often. Other companies that are really good out there, like Guardian, I have a policy with. Mass Mutual is another company. I think they've hit the $1 trillion mark now. Penn Mutual, Mutual Trust, Lafayette Life, New York Life, One America, just to name a few. There's, like I said, probably a couple dozen. Those are all mutual companies. They've got good track records for dividends. They've got good guaranteed interest rate. They've got pretty good flexibility with the overfunding. So yeah, there's the answer to that. And unfortunately, they don't unbundle these and say, here's exactly what you're paying. You just have to look at what your net is. Like, what are you actually getting after expenses?
Okay. So when someone's starting out, because I'm assuming there are a lot of people who this is a new concept for, do you have any tips on what they should look for when they're navigating that new contract?
Well, I think that cashflowbanking.com is a phenomenal resource. I think on YouTube, we have so many videos. If you type in, my name and Cashflow Banking, that really goes through this. We've even built courses for this. Even in my book, budgetingsucks.com, I have whole chapters on cash flow banking and cool resources and even video courses that people could buy in addition to that to get more detail. But even What Would the Billionaires Do? Another book of mine like goes into a ton of detail around this. Now, whether you want to invest and buy those books or whether you just want to navigate the YouTube channel, we've gone through a lot to help people
really
navigate
have.
this. Yeah.
I have one other clarifying question. So you said you prefer mutual over stock companies. And we know if it's a stock company, it's connected to the stock market, Wall Street. But tell us, just clarify, what does it mean if it's mutual?
Privately held.
Okay.
So it's not traded on the stock market. These still be really big companies and they're owned by the policyholders. So when there's a distribution, it goes to whole life policyholders. Now, I don't use universal life policies for cash flow banking. A lot of people use index universal life, which is given a minimum guarantee and you get to participate in some upside in the stock market, but it has a variable cost ratio through what's called M&E. So mortality and expense can increase over time. And so I like to have that more stabilized and fixed with cash value and whole life because you may want to utilize that more often and put it back in and, when good opportunities come. And so designing it right is really important. So, we've covered my relationship with Garda and we've covered a lot of the different, companies that you could use out there. But creating a certified cash flow banking, policy comes from cashflowbanking.com. And, another question that was in there, though, is are there guarantees to these?
Yeah.
And so when you put your money in the bank, there's the FDIC, right? So that you've got that guarantee or that background. Well, there's state guarantee associations. And we're filming this in Utah right now, where that state association has never been tapped into for $1 when it comes to life insurance policies. The FDIC has been tapped into to the tune of billions of dollars. So looking at the stability here versus the stability of most banks are lending money too frequently. I mean, they do fractionalized where they can lend $1 more than once and those types of things.
Yeah. Okay. Let's see if we covered all of Justin's questions. Oh, are death benefits still guaranteed if they go out of business?
So death benefits right now, it's happened most of the time if a company's gone out of business, another one buys them. But then, yes, there are limitations to how guaranteed they are based upon the state association and which state you're in and how much they're willing to guarantee. But that does give you a little bit of a backdrop. And, once again, why it's important to have these multi-billion dollar companies that have seen different cycles, that have tons of cash reserves, and I feel can recruit the best talent because they've got the money.
Yeah.
I think it's a little bit harder on these startups, and we've seen how a lot of startups are kind of hit or miss. And this isn't really a sexy industry. This isn't like something overly exciting that a lot of new talent is getting into necessarily. So to see a startup try to enter this arena, I mean, it just seems a little bit too volatile.
Yeah. So we know on your YouTube channel that there are a lot of people who are starting off their journey of building their financial literacy. So if someone's learning about these policies for the first time, when is a good time for them to get started? How much can they start putting into it if they don't have a lot of money?
I started when I was 19 years old with $50 a month.
Okay. So
wasn't married, didn't have kids, just started somewhere, right? And then there's people that are putting, there's people doing private placement life insurance, which starts at $1 million minimum to put into it. So there's the whole gamut. Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.